Welcome to the State of the Markets podcast. I'm Paul Rodriguez of thinktrading.com.
I'm Tim Price of pricevaluepartners.com.
And our very special guest is
Costa Vayenas. Welcome to the show.
Thank you very much for the invitation.
So I think we were put together by a mutual friend of ours who has some Swiss links. For people who may not know you, could you give us a brief CV, please?
Yes, I'm Chief Investment Officer at Genesis Investment Partners. So we work with first-generation technology entrepreneurs. So we're a multifamily office working for this group, and we have around 3 billion Swiss francs under advice. I also lecture at the University of Zurich for a few days a year, like 5 days a year. I've done that for a long time in the Department of Finance. And before that, I worked at UBS for 25 years as an analyst in London, New York, and in Zurich. So I've always somehow been involved in analysis and writing.
And you, on the topic of writing, you've written at least 2 books, the most recent of which is The Swiss Franc from 1798 to 2055.
Yes.
How did that book come about?
So, given kind of my analyst background, I was always interested in kind of charts, historical data, and over the years, I'd built up databases going back quite some time. For example, one of the things that I put together was the minimum interest rate across 5,000 years of history that was published in the Financial Times. And that kind of showed you, based on the best collateral over those centuries, what were the rates. And so that was an example of something that I did. And then I was doing quite a bit of FX. And sometime last year, I noticed I was the only one actually doing some historical work on the Swiss franc. I found that a bit odd. But then I contacted the central bank, the Swiss National Bank, asked them for some more data. First, they were very helpful. So they were going to open the archives for me. But then they came back and said, well, there's nothing in the archive. Unfortunately, we can't help you. And so that made me think, well, if they don't have the data, there was trading happening before the central bank was created, it would be interesting to find that data. And that's kind of how the journey began.
Now, I haven't read your book yet, but I'm assuming that the Swiss franc is probably been the best performing fiat currency over the period that you've written about it. Is that true?
Yeah, so I didn't go about trying to find the world's best currency in terms of performance. I just wanted to kind of see what was the value of the Swiss franc as far back as we could find it. And it begins around that time, 1798. And the result is shown in the book that, I mean, you have a very substantial collapse against, the US dollar. Has lost an enormous amount of value, around 85%, sterling around 90% over that time. So given that sterling and the dollar were our reserve currencies, and are a reference for many, that would probably imply that it's still the strongest currency.
And why is that? Is that because in the past it's had gold backing?
Well, what's very interesting, what I'd kind of discovered is originally it was only species. In other words, it was only the metal. There was no Swiss franc banknote, unlike Bank of England banknotes or greenbacks. And in the early 1800s, it was interesting. Whenever there was a crisis in the US or UK Napoleonic Wars, etc., there would be suspensions of the gold system, so that the paper paper notes were no longer really backed by gold. And the Swiss didn't have that. They just had these metallic coins. And the same thing happened with the countries next door, all around Switzerland. They would devalue, they would actually have fiat currencies. France had hyperinflation after revolution. So Switzerland was this island of kind of sticking to the metal, not having paper money, and had this very unusual situation that there wasn't one single currency in the country. Each canton had its own. And that had the side effect of acting as firewalls in a way, because you didn't have this central issuing authority. So these are some of the things that I discovered and found interesting.
And would you say that part of the success of Switzerland as a country is that it has an unorthodox structure compared to the larger countries of Europe?
Yeah, so you see this very early on when you compare Switzerland to the neighbors. The neighbors were monarchies, absolute powers, constantly involved in war. So they needed a lot of money to finance that. They had grand palaces, big events. They sponsored musicians, so they had great musicians. And Switzerland had none of that. It was kind of like a light state in that sense, in terms of revenue. And the other unusual thing about the country was that since it didn't have natural resources, the key export was mercenaries. And so these mercenaries were paid by these wealthy monarchs in the neighborhood. They trained the mercenaries, so Swiss didn't have to pay for training. And they paid their pensions as well. So the net effect was current account surplus. Money was flooding in, gold was flooding in, and they couldn't possibly spend all this domestically. So from very early on, Switzerland as a construct was kind of quite different from the neighbors.
When you were writing the book, it's the history of the Swiss franc from 1798 all the way to 2055, which means that obviously you're looking into the future. How have you projected into the future, and why did you pick that particular date?
Yeah, that's a good question. And some of the people who know me reminded me that I don't make FX forecasts. And they said, you're kind of always careful about making forecasts. And now you put this into the title, how can you do that? And then I tell them, well, actually, I don't forecast. So what I did was in the year 2025, I had a look at the 30-year bond for the US Treasury and the 30-year Swiss government bond. And I used that snapshot of the interest rate differential between the two to point out this massive spread between the two of them. So the US Treasury snapshot at that time was around 4%, just over 4%, and the Swiss bond was yielding 0.3, which is kind of what we have today as well, still. So you have this massive gap, and the question simply was, so, what does that mean? And history and theory tell us that in a currency pair, the higher yielding currency tends to be the one that depreciates over time. We have this also in interest rate parity theory, where over centuries you can compare sterling with the French franc, and so there's a long history to that. And so the conclusion, the hypothesis simply is, there's this huge gap for the next 30 years. Somebody is still buying these Swiss franc bonds at 0.3%. What are they thinking? What are they expecting? And I leave that to the reader, but the implication is simply that the market in 2025 is still pricing in a stronger Swiss franc over the next 3 decades. Has to be one reasonable conclusion. And that's how the number 2055 gets into there without actually making a forecast.
Oh, that's very interesting. So, in terms of historical turning points, in your research, which period do you think was the most pivotal for the evolution of the Swiss franc, and why would that be? Excuse me, why would that be?
So, if you consider that the Swiss Confederation declares independence in 1291, so it's quite an old confederation. What happens in 1798 is something unthinkable. Their big next door friend, longtime friend, they've had treaties of perpetual peace with the Kingdom of France and 14 monarchs from the 1400s. And France had actually given the Swiss free movement of merchants. So it's kind of a EU Schengen agreement. So they're very good friends. So in 1798, the unthinkable happens. After the revolution, Napoleon needs treasure and he needs a shortcut to speed things up on the battlefield, and he invades the Swiss Confederation. And this catches the Swiss completely off guard. But it has one important result, which is Napoleon discovers that every canton has its own currency. And his conclusion is, a country needs a currency, and you shouldn't be having all these different currencies. Copy France, do what we've done in France, one state, one currency, and you can call it something like the franc. If you want to, you can call it the Swiss franc. And so that's a pivotal date, 1798. He invades, and within a year, there's this new currency called the Swiss franc. But the Swiss hate it, and they hate everything about the new flag that was introduced and this new single currency. And very soon afterwards, they kind of abolish it and take back their powers. So that was pivotal. Another pivotal moment, I would say, is for a long time, the Swiss kind of followed France and the French franc. And the French franc, after the revolution, was a strong currency. It was backed by gold. But then the pivotal moment, the second big pivotal moment, comes around the First World War. First World War causes a lot of inflation, also in Switzerland. So I'd say that's a big moment for the Swiss franc as well. But the fact that during the Second World War, it becomes the de facto reserve currency in Europe, because the only alternative currency that you can convert into gold is the US dollar. After the war, the point that the Swiss franc kind of withstood the war and came out stronger relative to what had happened in the neighborhood is also very significant, given this kind of long-term history.
So presumably one of the factors behind not just faith in the Swiss franc, but also the stability of the Swiss economy is because it hasn't engaged in warfare to the extent of its European neighbors.
So it was, so when you add up all the mercenaries that they made available, is 1.5 million soldiers participated in European wars, also worked for the British in Canada, in Egypt, in India. So the Swiss were collecting money from these mercenary activities. So they were involved in wars, but the state was neutral. So these were considered business services. And that helped spare Switzerland from being involved in war, because the neighbors, it wasn't that they were pro-Switzerland, it's just they didn't want their future adversary to be able to have access to Swiss resources. So they preferred to say, okay, Switzerland is neutral. We agreed to that. So, you can't, in future, you can't invade them like Napoleon did. We'll sort that one out. And this led Switzerland to be spared from the wars because the neighbors tended to agree to leave them out. So that's kind of, we talk about Swiss neutrality, but Swiss neutrality was never accepted by a neighboring country the moment it appeared to be disadvantaging them. So neutrality worked because the Swiss kept their head down, and the neighbors tended to agree with it.
There's a wonderful perspective on the First World War that Dominic Frisby mentions in his book, The Secret History of Gold, that's just recently come out. And it's that fairly soon after the First World War started, all of the competent powers basically went off gold. But if they'd stayed on gold, the war would have to have been over basically by Christmas, as everyone thought it originally would be, because they'd run out of money. So if we'd kept to a hard money standard, millions of lives would have been saved, and the course of Europe would be completely different. It's a fantastically pro-gold perspective on history. Don't know whether you share that view.
It's very interesting. So what I discovered was so in around the First World War, in one single year, Switzerland had 25% inflation. And that kind of shows you that even if you're on a gold standard, as they were, what that new central bank, because it was a new central bank, what the new central bank wanted to do was help finance the government. So the view of the central bank was, whatever it takes, we're going to help finance our government. So Switzerland was not in the war, but it had to suddenly, find reinforcements and prepare for war, and that cost money. And so what I discovered was, despite being on a gold standard, you can have a situation whereby a central bank gives the state credits. So it was obvious that there were various tricks that were being used. The other thing that I discovered during the Second World War was you can have inflation from too much gold. If too much gold is flowing in, and you have a gold standard, the requirement is you exchange new money, printed banknotes, for the gold that's flowing in. So it is very interesting that even on a gold standard, you need to follow key rules, and it is quite tricky. That's kind of what I discovered.
Didn't Spain experience the same problem after the conquistadores, that the inflow of gold basically caused extremely high inflation across Europe?
Yes, that's a good example that too much of everything, including too much gold, you need to deal with it. And one interesting thing, so as I mentioned, First World War, Swiss National Bank got it wrong. It resulted in high inflation in one year. They corrected that in the following years with, deeply negative inflation, -12, -15. So at the end of the First World War, they were back to where they were before. So in a way, by sticking to the gold standard, they had a strong currency over the cycle. But what I discovered in the Second World War, fearing inflation, what they did was, as this gold was flowing in, too much of it, they decided to sterilize the gold inflows. And they did that by lending this gold to the government. And so I found that interesting. We know about currency sterilization, but I wasn't aware of the extent that you can also do gold sterilization. So yeah, when you have too much gold, you need to be ready to deal with the consequences if you're on the gold standard.
I seem to remember that I read somewhere, I can't remember where it was or the exact date, but the Swiss franc, the Italian lira, and the US dollar were all at parity. It is a phenomenal testimony to how much the Swiss franc has strengthened against the US dollar and certainly against the Italian lira, which is now being masked. Its weakness is being masked by the euro. So, for people who aren't familiar with the lira, before it was converted into the euro, it was probably trading around 2,500, maybe 3,800. So numbers of that magnitude, just to show you how economies had differed and how in different inflation rates had differed, and how if you look at the when we look at the US dollar, we know its dominance is because everything is traded in dollars, but the Swiss is much smaller in size, does not have that sort of dominance, yet its currency is held up even better than the mighty US dollar with all its nukes and superpower status. So it is quite incredible how strong the Swiss franc has been. What do you think are the biggest economic and societal challenges that creates for the Swiss people, and indeed, I guess, the Swiss government?
Yeah, so I actually have the numbers that you referred to.
Okay,
So,
brilliant.
um, uh, against the Italian lira in 1861, one Italian lira cost 1 Swiss franc.
Ah,
I looked this up because a few months ago, I was speaking to an Italian producer who had inherited a business, and he was saying, my father said, had we converted our lira, we would have been rich.
yes.
So, so then I wanted to look that up. So, 1861 parity 1 to 1.
That's
Now,
phenomenal.
by 1945, so the end of the war, it was 441 lira for 1 Swiss franc. So you can see that there was, a loss of 99.8%. And that trajectory is really what happened to almost everyone else in the neighborhood, including to France and certainly Germany that lost several currencies and the Austrian-Hungarian Empire. So this was happening all around Switzerland. And by 1998, when the Italian lira was converted to the euro, it was 1,210 lira for 1 Swiss franc. So
Was it really as low as that? Okay.
yeah.
Yeah. Okay. I must be thinking of sterling then, because against sterling, it was definitely over two.
Well, whether it's Italian lira or sterling, I think this is what our American friends would call a bug tussle, which is a conflict between two insects.
Yeah, so I can give you the numbers for sterling, which is around 1798. You were paying 25 Swiss francs for £1 sterling, and as of this morning, you were paying around 1 Swiss franc and 4 Rappen for 1 sterling. So we've come down from 25 to 1 from 1798. So we're actually close. We're based on my calculations, we're around 3% away from a 227-year low in the sterling Swiss franc exchange rate.
Goodness me, that's telling you something, isn't it?
Yes. So to answer your question, sorry, about how does Switzerland deal with this? So the first thing is there's an attitude issue, which is the attitude is the central bank is not going to bail us out by giving us a cheap currency. It's not going to happen. And so you cannot build your business on the assumption that you're going to get a depreciation. You cannot, as an exporter, expect to get a cheaper Swiss franc. So this is ingrained into people. Any business they start, they're thinking about, what does that mean? Will it work? What can I do to address this issue, which is structural and is not going to change? And so this results in a focus on, so what can I produce? What can I sell that people are still going to want to pay at these rates, at these exchange rates? And this causes Switzerland to kind of move up the value chain. And you can see, for example, one of the very first products exported to China in the 1700s was watches, Swiss watches. And the imperial court was very impressed and bought the stuff and paid for it and was willing to pay for that. So you can see from very, very early on, there was this thing about, so who's going to pay me more? And in fact, when you look at the prices charged for mercenary services, Swiss mercenaries had the highest rates in Europe. There was this expression at the time, no money, no Swiss. And the fact that the Pope took the best, highest paying mercenaries to create his own army, and 500 years later, he's still paying them. He's paying them around 1,500 euros a month, so not a lot at the moment. But you can
Also, the
see,
pike as a weapon has been superseded by other technologies.
yes. So you can see that I'm answering your question here about, so what does this mean? It means that you need to find ways of moving up the value chain.
Yeah. So
Otherwise,
yeah,
you're
sorry.
not gonna sell.
I understand. Yeah, that's so. What that gives actually is an element of certainty towards businesses who know that the currency is just going to appreciate and it's going to be relatively stable. Although we know within the history we had that period in. I'm just looking at the chart now, and of course you will know in
2015.
exactly in 2015. Now I remember when the when they announced that they were going to tie their currency to the euro and thinking, why on earth would you do that? That seems like absolute madness and it can't last. But they were adamant that they were going to do everything it takes to stay there. And then for people who don't know, in 2015, this is what they told the market. This is what they told everybody. And for a period of time, it was relatively stable. And by a period of time, I mean a couple of years. It was sort of within a tight range. And then one day out of the blue, they just said, actually, no, we're not going to do that anymore. And the currency appreciated by, 30% in one day, something like that, which is in currency terms, an absolute phenomenal move. It's just such a tidal wave beyond tidal waves. It caused bankruptcies. It caused all sorts of incredible problems. And it also gave a slight, why they would do that and lose trust of the market. Because, of course, after that, you're like, well, can we really trust anything they say? So it seemed like a really dark period in their history. And I wonder what you thought of it.
Yeah. So I would view that within kind of the longer term context, which is on numerous occasions, the Swiss franc has been pegged to something. So it was pegged to gold, for example. It was pegged to silver. By definition, then it was pegged to the US dollar, which was on the gold standard.
Right.
And so for a time, it was pegged to the Deutschmark. And so there's this long history of pegging. All those pegs collapsed, though. So the first thing, so there, so when global currencies start weakening, and the Swiss franc strengthens, there's a bit of a panic at the central bank, which is like, there's this fear that, inflation is kind of, at zero, it's negative. It's like, okay, we've got to do something. Now we've got to do something. And so the first reaction is, okay, let's peg, because it's not going to be so bad. So then they peg, and then very soon the peg causes money supply to rise, and then it becomes obvious that it's unsustainable, right? So they have tried to do other things to try and, instead of a peg. So for example, in the 1970s, following President Nixon's move away from the gold standard, you had a very rapidly falling US dollar. And so there was a lot of money, dollars flowing into Switzerland. And the authorities decided to introduce negative interest rates on these dollars. And so the first thing that they did was 3% negative interest rate per quarter.
Wow.
Yes. And so this was minus 12% per year. And still the dollars kept flooding in, because now you had petrodollars from Saudi Arabia and everywhere, and the dollars just kept flowing in. And then they moved to a rate of minus 40% interest. Now they called it a commission. And at around minus 40%, the inflows finally stopped. So we have this case in history. We have a data point that says, if the dollar goes into free fall, it stops at minus 40% in terms of not pushing up the Swiss franc. So they've tried many different things to counteract the appreciation. And in that context, the peg to the euro really started around after the Greek bankruptcy, which I think was around 2010, if I'm not mistaken. So you had half a decade where it kind of worked, but towards the end, and I know this from traders at the Swiss National Bank, they could no longer maintain the peg, in the sense that the margins, the spreads were basically so close. They were making mistakes in their trades. It was an unsustainable story. And so the test always is, okay, so now you've pegged. Are you really willing to import this inflation? And the answer is always no.
Absolutely. All pegs eventually fail. It was the cause of the financial crisis, the late 90s, where the Asian currencies pegged to the US dollar. And it's one of the reasons why I always thought the euro would fail, because for exactly the reason that you've said, are you willing to import this inflation and make your economy? And if the Swiss franc was going to be as strong as the euro, why didn't they just adopt the euro? And of course, they're never going to do that. So,
yeah. Perhaps to also complete the answer to your previous question about, so, how do the Swiss manage the fact that they're dealing with appreciating currency? You do get something in return for it, which is very valuable. What you get in return are kind of at least two things. The first thing is everything that you import gets cheaper and cheaper, right? So if you're paying for software in US dollars, it's getting cheaper and cheaper. If you're paying for ads denominated in dollars on a US service, those get cheaper in Swiss francs. So your inputs are getting cheaper. If you're importing commodities, they're getting cheaper in Swiss franc terms. So your inputs are kind of mostly under control and tend to get cheaper, which allows you through that process also to move up the value chain, which is you can buy more ads, you can buy better quality cocoa, so that helps to kind of differentiate your product, at least on the input side. And a second important thing is the cost of capital falls. right? So at the moment, interest rates are zero. Inflation is also zero. So if interest rates are zero, your mortgage is zero plus the best spread that a bank would offer you. So your capital costs are very low. So you do get something for a currency that the market assumes is going to stay stronger, and that helps.
That's a brilliant answer. Tim, do you want to jump in? Because I've got plenty
Yeah,
more.
the Swiss National Bank, as I understand it, is a listed business. Is that correct? You can buy shares in the Swiss National Bank.
Yes, and if you might recall that many central banks started out as private companies.
Because the concern I would have, the conceptual concern I would have, is that it's a business you can buy shares in. It can create money out of effectively thin air, but it can then use that money to buy real assets, such as, for example, Apple stock. If I did that, that would be illegal.
Mm. Yes.
Do you see a potential sort of ethical concern here?
Yes, I think there are many problems with this arrangement. But as I mentioned, it has a historical context. Many central banks started out as private entities, were given a private charter. I think that was true even in the case of the Bank of England. I stand under correction, but there was a time when the Bank of England had greater autonomy as a private entity, if I'm not mistaken.
But I suppose my next question would be, how do you view the world of well, it's a big question, the global monetary system and central banks. How would you describe the stability of this arrangement now in 2025? Because I'd say it's chaotic.
Yes, I mean, many things are rapidly changing, and are very, very worrying. And you mentioned Apple shares. I mean, why should a central bank be investing in Apple? Why should a central bank be buying the S&P 500? That's not right. It's strange, right? You would expect your central bank to hold other assets, gold, for example. But a central bank holding equities is very weird, I think. And it's holding them in a currency that is depreciating. So the Swiss central bank has reserves that are going to fall in value in Swiss franc terms. So many things are kind of wrong, quote unquote, in kind of like a traditional approach where we may have been used to central banks with smaller balance sheets, more traditional, and today they're everywhere and involved in so many things and so large, and that's basically the state. So there are many problematic aspects to this. The key differentiation between QE in the US and the euro area and possibly the Bank of England is that there's nothing left to buy in Switzerland, and so the Swiss National Bank has bought foreign assets. But that's still QE. It also means that the currency is weaker than it would otherwise be, and it means it's holding assets that could fall in value.
We had Alistair MacLeod, formerly of Gold Money, on the podcast a few weeks ago, and I asked him whether he thought central banks could survive the storm to come, and his view was basically no. What do you think about the future of money?
Future of money. I mean,
Because you've written about democracy and you've also written about technology, so it seems like there's now a
yes.
confluence of multiple factors all crashing into each other, and it's by no means clear what the future may look like, in as much as one can ever say what the future looks like.
Yes. No, I mean what I learned from the my 5,000 year chart, 5,000 years of the lower bound of interest rates, was that there were all kinds of crises. There were all kinds of devaluations going back to Roman days. And so looking back over the period that, many crises, but somehow, these regions, countries, they survive, they recreate themselves, they reestablish themselves. And we may be in such a phase now where, there is so much government debt, so much, such large central bank balance sheets, and so many potentially destabilizing factors that we could be in an era where we're going to see a few big crises kind of realign arrangements. And this is not to make a prediction because I can't predict this, but it just seems strange from a historical context, given the level of government debt. Now, in terms of kind of the future of money, I mean, there are 8 billion people on the planet. They need to eat. They need services. They need to be able to exchange. They need some value, some asset that they can exchange for food. So I'd say that, there'd always be this need for finding something of value that allows you to purchase these things. And as long as we still have competing currencies and competing assets, and we're still free to buy and sell gold, because there were many times in the past when that was restricted in the United States, for example, for a long time. So as long as there are, there aren't capital controls, which has also happened on many occasions, there are enough alternatives, I'd say, available to kind of act as a degree of a disciplining force. I am, however, always also surprised that, when you have these really extreme movements, I mean, look at the Turkish lira, right? There were numerous occasions where I thought, like, how's Turkey going to survive this? 70% interest. And then it just disappears from the news headlines, and the Turks kind of sort it out again.
But also, I mean, you've alluded to it already, but one thing that economists can do is they develop a black economy that operates outside the official one.
Yes,
humans are very adaptable.
Yes, and I think that's a really good point. So, and I think Turkey uses many different currencies, the euro, dollar. This is exactly what happens. You can see people making their own arrangements.
So when it comes to the Swiss people, they have perhaps a unique attitude, or they certainly have a unique way of being governed in cantons. How much of that attitude do you think contributes to the uniqueness of the Swiss franc's strength?
That's a good question, and I think if you had tried to copy the Swiss model, it would be really difficult to do, because there's so many little features to it that would just be hard to maintain. So there's this unique model. So and it seems to be working, and it seems to be appreciated. So when you look at the OECD does a survey on trust in government, and Switzerland has the highest level in the OECD. And so this kind of suggests that people on the whole are pretty happy with the arrangement. And I think the reason that they're happy with this is they tend to think that they have power. So the country has no prime minister and has no head of state. It is run at the federal level by a committee of 7. And if you next visit Switzerland and you ask a Swiss person to name any of these 7, they may remember one. They certainly wouldn't know who is the acting head for the year because they rotate. So the system is kind of built to be anti-strongman. It's almost like you don't want strong politicians. You want careful, modest people at different levels. That's kind of how the system works. And you have this repeated 3 times at 3 levels, at the federal level, at the state level, the canton level, and then at the city or municipal level. And I think the most interesting feature is that on any question, you can collect 100,000 signatures and you can force the entire country to vote on this. So sometimes you had ridiculous questions like, do you agree to abolish the army? And I think a third voted yes. But
Wow.
what this does is it lets off steam, right? So so even if you have very strange questions, it causes people to kind of have to go to the polls. And there's a referendum coming up very soon that wants to impose a very high inheritance tax. At the moment, there's no inheritance tax. It wants to impose this on very wealthy people. So, so you have these constant challenges to the system from the left, from the right, and that actually makes the system strong. So, to answer your question, I think the way the system is built is people feel somehow that they have power. They have some degree of control. And when I look at many other countries, you get the sense of a loss of power.
Yeah.
Or people feel like, there's no matter, they vote, they go and vote, and then there's election and there's a government, but they do whatever they want to. And here you don't have that feeling to the same extent.
It's so that's really, really fascinating. I mean, you say people have the feeling that they have power, but it seems like people do actually have power. Whereas in the UK, we have this system where you can get a certain amount of signatures and then a question has to be raised in Parliament, but what they basically do is ignore it. And we also had a very recent situation where a prime minister didn't last very long, Liz Truss, and she explained that actually the real power doesn't lie with the government. And I don't know whether this is scapegoating or whether, I mean, why she would lie, I'm not sure, but who really knows? So the veracity I cannot confirm, but she certainly says that the problem with the way our government works is it's not actually we're not being governed by the government. They try to bring in laws, but it is the civil servants who decide how those laws actually are actually implemented, and whether they're implemented well or badly, or they can scupper it. And then when it comes to running the economy, that's run by the Bank of England, and they're just sort of accountable to themselves. Whether they make mistakes, they can blame the government. Now, it's an interesting angle, because when it comes to this answer about Switzerland, how would other countries emulate it? And they're just not going to be able to. A, because we'd have to come out of one system, and B, even if we could, how could we replicate that attitude? And it's absolutely fascinating. I see why you think the Swiss franc's going to be strong into 2055.
Yeah, I think I read that Liz Truss comment about the power not having power, and I was really surprised by that sentence. I was like, "What? You're the prime minister, and even there you say you have no power?" It was. I found that really strange. Obviously, in a modern democracy, prime ministers deferred to their advisors and civil servants, and that's correct to get good information. But I found that hard to believe that if a prime minister wanted to introduce a policy and had the backing of parliament, that wouldn't go through.
So I think you have the same problem in the States, which is you have a new president comes in and has lots of big, bold plans, for example, to remove waste, cut waste out of the system. So you have this thing called Doge, and everyone gets very excited about it. And then suddenly it transpires that the president has a lot less power than he actually thought, because there is a, dare one call it, a deep state operating behind the scenes, which won't permit big change.
Yes. So I think it's important that we never want to be in a situation where a politician has, total power over everyone and everything. So we want checks and balances to work. And one suggestion that I would make is, okay, so the Swiss system cannot be copied one-to-one, but it must be the case. It must be the case that people can be consulted more often on more things, and that those consultations actually are binding, right? So I regularly read in the Financial Times about the UK budget, and there's so many articles about the budget, every few days. It's like I find it hard to believe that there's so much about the budget. But one way to kind of enhance power, return power to the people, would be to let people at the local level decide their own finances, right? And now, what am I talking about? So in Switzerland, you have around 3,000 communities, local communities. That could be, a town, and that's where the tax rate is decided. So you have competing tax rates. And if you don't like the tax rate in your neighborhood, you move to the next neighborhood where the taxes are more to your liking. And if you don't like that, you can collect signatures at the communal level. You only need 5,000 perhaps. And then you change the tax system. So the power to determine how you will be taxed is kind of inverted to the UK. So the UK is like this, UK is like an inverted triangle where most of the money goes to London, and London hands it out again. And in Switzerland, the base of the triangle is at the bottom. So 1/3, 1/3, 1/3. And it's collected at the bottom and handed to the top. Top is last. So that reinforces the issue that people feel that they're empowered. When they're walking down the street and they see a new bridge being built, they'll be like, yes, I approved that 6 months ago, so I'm glad to see it's happening. So there's more sense of control, and I think that's something that kind of calms people. Doesn't mean there aren't problems. There are many problems, but I'm just saying on there's some calming effect of feeling that you're deciding stuff.
I didn't think it was, I thought it was good. I didn't realize it was this good. That is quite amazing. But actually, you touched upon something that I was going to ask about. What are the problems? What are the potential problems, or what are the actual problems with this type of system?
So, so one of the big problems that you have now is that Switzerland has various treaties with the European Union. So throughout history, the neighborhood was always extremely important. Switzerland has no access to the sea, so you got to keep your head down, be friendly to get access to the sea. And you have to get along with your neighbors. And over the years, those relationships have become stronger. And one of the treaties signed a few decades ago is not free movement of persons, but free movement of labor. And that means the moment you have a certificate, an offer, a job offer, you can come. So Um, this has resulted in an influx of very talented people. And so they're definitely helping and boosting the country and the economy and introducing new things. But they're also causing rising real estate prices. And so I'm aware that this is a problem in many countries, but so younger people are just struggling to get onto the real estate ladder. Um, so there's a sense that, perhaps there are too many people. I always remind I always remind my friends that, when you live in a country where everyone's leaving and the population is declining, that's far worse, right? You don't get access to doctors. I mean, look, a lot of Eastern Europe is in that situation where there's migration out of Eastern Europe and countryside is emptying. There's no one. So you don't want that. Can you get this perfect stability of, a stable population? You probably can't get that either. So, so this is one of the issues when you say what are the problems. This is one of the problems. So the trains are getting fuller. Um, okay, you can say that's no reason to complain, but people are complaining about that.
Yeah, I can't see many downsides actually, but yeah, incredible. Tim, I have more questions. I just again, I didn't.
Go for it.
Okay, so with regard to, we go back to the top of the show where you said that you teach for 5 days every year.
Yes.
What exactly are you teaching there? Is that general economics or is this history of the Swiss franc?
No. So at UBS, I was in charge of emerging markets. So I covered emerging markets cross assets. So FX, fixed income, equities, and what I teach at the University Department of Finance focuses on emerging markets, emerging market finance. And I mean, emerging markets are still an asset class, um, and appear typically in diversified portfolios. And so there's still interest in that. I always remind people in the very first lesson that, just because there is an MSCI index or an MB index or whatever it is, doesn't mean that you can't recreate and redesign and come to your own conclusions on whether or not the concept of emerging markets is valid or not. So that's kind of what I focus on, and I enjoy engaging and speaking to young people who see the world very differently, and that's why I keep these 5 days a year. They haven't fired me yet.
I'm sure they're not going to. That's
could happen. Yeah.
What's the straight? Well, don't say strange. What's the most surprising attitude that you've heard, or sort of comments about finance or misconceptions maybe that you've had from your students?
It always impresses me how little they appear to know at that. But I'm always respectful of their questions and what they say, because I mean, we're talking about a market. They're buyers and sellers, and we can't all have the same view. That would be terrible, right? We all want the same thing at the same time. So I take some of these questions. Yeah, I see what I can learn from them. I think the students have become more conservative in a way. Um, yeah, I don't, there are many different questions on different topics. but it's true that I get a sense that they have not focused so much on a broad education, or it's perhaps they just want to get their marks and go through to the next step. I don't know.
Mm. Now, it's interesting you say they've become more conservative, which seems completely the opposite of what's been happening in the UK and certainly in America. So, with regard to your fund you mentioned, what can you give us a flavour of what you're invested in, or is that something that you can't talk about?
Well, what can I say with regard to that? So we work for tech entrepreneurs, wealthy families, first generation wealth, and by definition, these people made money by being very focused and narrow, and they were very successful. And what we therefore invest in is not in the assets that made them wealthy, because they already know that and can do that. And it is about offering broader assets, different assets, I mean, more traditional classical assets, and to find ways to kind of protect their wealth, and to see if we can help grow that over the medium term. And each family is different in what they require. But I would say that it's careful, cautious investing. Yeah, we want to preserve wealth.
So, a very similar attitude to Tim's fund, which is yeah.
So tell me about your fund then.
Well, I guess our objective is first capital preservation and then attractive returns consistent with the approach for preserving capital. But the composition of that fund is intriguing, probably to many, because we don't hold bonds. We have a fairly significant exposure to precious metals, to precious metal miners, to commodity miners more generally, and systematic trend following fund. So it's a somewhat eclectic blend of things. But I guess the way I would defend its orientation is that there are such significant. I mean, to go back to your observation about emerging markets, I think that the phrase is really patronizing because it implies that developed markets are somehow superior. I suspect that the finances of the developed world are demonstrably worse than those of the so-called emerging world. The West is bankrupt, and I suspect on the margin, the average private client portfolio does not reflect that. So the concern we have as a business, and I have as an individual, is that there is a debt reckoning coming, and we do not want to be on the wrong side of that reckoning when it comes to pass, which could be quite soon. It may be happening now. I don't know if you're following, for example, developments in the silver market in London, but there is an interview that's been doing the rounds on YouTube. Two guys having a chat just a few days ago, David Jensen and Andy Schechtman. And Jensen, who I think is also quite freely available on Substack, strongly suggests that basically the London silver market's broken. And not just that, but there may well be a bullion bank that's actually already in default. So it's very difficult to trust prices in the metals market, specifically silver, because they're probably not real. And that's a reflection of extreme, let's say, call it monetary instability.
Yes.
But it all comes down to debt. I mean, in the words I mentioned Alison McLeod earlier, I think in his view, he'd say we're at the terminal stages of the biggest credit bubble in history. And there's going to be widely distributed pain and fallout from that. So choose your asset classes carefully.
Yes. And we also don't appear to know where all the gold is.
It's in China, isn't it?
But we don't see that in the IMF data.
Because what this comes down to is a crippling loss of trust in all institutions. That you don't know who or what to trust now. And that's problematic at an existential level for someone like myself or for Paul, who is using price discovery as the method for identifying valuation. If you
Yes.
can't even trust the prices, what on earth can you do?
Yes. So, what share of your portfolio is equities then, or your fund?
Uh, Probably something of the order of around 60 to 70%, but a large part of that is in turn allocated to what we'd call real asset type equities, i.e., things that are basically related to the industrial production of materials. So mining,
Yes.
precious metals miners, commodity miners, more
Mm,
generally, and then bullion.
very interesting.
But other people would say, well, that's very risky. And we'd say, well, what kind of bonds do you own? Paul alluded to the short-lived Liz Truss administration that
Mm,
year, which I think was 2022. There is one, I keep referring to this incident, but there's one 50-year inflation-linked UK government bond or gilt. During that year, between January and the autumn, the price of that bond fell by 85%. And
wow.
that's the so-called risk-free rate.
Mm,
And most pension funds here in the UK will be chock full of quote assets, unquote, like that. So as I say, I think there's a day of reckoning coming, and we just don't want to be caught on the wrong side of that as and when it arrives.
yes. Yeah, very interesting.
I think it's fascinating that Costa, you're doing a similar thing, but you're looking at it from the point of view of your clients being already invested in tech and AI. I'm saying AI. I don't know if it's AI, but it's certainly tech related, which is obviously very hot at the moment, and therefore you want to find things that are will be a return of asset and safe and but still make money. And Tim's coming from a point of view that the whole system is going to falter, and because of the bad management that we're seeing and the differences between the Swiss government or the way the Swiss system is run and the way the West is run, that ultimately will lead to a day of reckoning, and the cracks in the system are appearing and becoming ever bigger. But both of you are trying to achieve the same thing.
Yeah, it's interesting. It's there must be many people out there who feel that way. And I mean, one interesting observation I'd say is the wealthier the people that I meet, the more concerned they are about protecting their wealth and looking for alternatives. And perhaps because they're more aware of how, wealth was lost in previous generations. And yeah.
I mean,
Paul and I, sorry to cut in, Paul and I had dinner on Friday with a gentleman who manages money in Switzerland, and he has a very successful wealth management practice, and he's pointed out on innumerable occasions that it's a lot more difficult. It's one thing to create wealth; it's an order of magnitude, perhaps more difficult to actually retain it. So we have this expression, which I'm sure you'll be familiar with, which is shirt sleeve to shirt sleeves in 3 generations.
Mm,
Real capital preservation on a multi-generational basis is extremely difficult to achieve.
yes. And people are worried about that.
well,
Um,
you say that, Costa, but actually, I would say that you and Tim are outliers here, because from looking at it from the outside and looking at market history, I can see that most people are being drawn into the AI tech story, are being drawn into, say cryptocurrencies, etc. I say drawn into in the sense that there may be great technology there, but that doesn't mean that these valuations or the way they're moving is going to be sustainable, because there's too many people trying to get rich very quickly. And as Tim says, maybe we're in the correction at the moment. We've got some smart people who think actually no, it's going to come a bit later. But either way, we are definitely heading towards some form of major reckoning, whether it's weeks, months, or years. We are closer. We're getting closer and closer. And as we get closer, fewer people will be in your camp, in both of yours camp, because it will appear more and more that you guys are wrong and they're right, because they're investing more and more into these assets that appear to be performing really well. And that's the whole paradox of markets. When it seems like they are the safest, they are the most invincible, that's actually when they are the weakest, and that's when it's all ready to turn. But
that's largely a reflection of the rise of passive income structure, passive investment structures. So people who have no view on the market are giving their money to organizations, no names, BlackRock, and then those passive investments are then just sucking in capital, because for as long as it's going up, they'll suck in capital.
Yes, exactly that. That's
and that's not a valuation driven investment. That's a momentum based investment.
Yes, but that's always the final phase is always a momentum based, because it's when rationality goes out the window. It's just buying because it's going up, not buying because there's anything behind it. But that's when it's the most compelling, because you've got some history that shows that that's the right way to do it, and it's very hard to convince people they're wrong. So my point was that perhaps in the people that you speak to, Costa, or the investors that you speak to, maybe, well, at the top level, I'm sure that they're rich for a reason. They have money because they're smart, and they have money because they understand that you need to protect it, and they're going to give their money to good people to manage.
Or behind every great fortune lies a great crime.
Well, if they keep changing the laws, right? I mean, for what is legal and what is not. Yeah.
Yeah. But I guess it's one of those things where you call it the is it the recency bias, where it's the people that you meet shapes your view, right? But I think if you look out to the masses, which is what is ultimately driving the markets, I'd say that your views are very much niche, and I don't mean that in a negative way. I mean it in a positive way.
Yeah, I mean it. Perhaps I'm surrounded by people who express these concerns more than so that I'm probably influenced by that. But also, I'm more aware of kind of like the historical crises and the trigger points, and because I'm interested in that. And I don't know where we are exactly now in this kind of situation, as you mentioned, given all the risks, but you do need a trigger, and one of the triggers that you often find is when a safe asset suddenly magically one morning is worthless, right? Subprime bonds used to be AAA at one point, right? I mean, they were the safest asset class, and then one day they were suddenly worthless. And so those kinds of shock to the system would be a major trigger. What I notice in recent months is more and more cases of fraud being discovered, and that may also be kind of a sign of these trends.
Absolutely. I think that's absolutely right.
Well, that's what J.K. Galbraith called the bezel in his account of the crash, which is a fantastic coinage.
I just wanted to make sure I understood your comment earlier about the minimum interest rates over a certain period. I'm not. We all know what the for example, the Bank of England rates go to 0.5 or 0.2, whatever. That's the minimum rate. And Swiss interest rates have gone negative. Is that what you were referring to by minimum interest rates, or have I misunderstood it?
So what I produced was so we have all this data going back a long time, and we know the interest rates from in many different jurisdictions, Mesopotamia, ancient Greece, Roman times, the medieval era in different jurisdictions. And we know the rates based on different levels of collateral. So the best collateral was typically gold. Another slightly weaker was silver. And then a third type of collateral was a commodity, agricultural commodity, typically barley. So based on that collateral, you had different interest rates in the same jurisdiction. And what I wanted to see was, so what was the lowest interest rate across 5,000 years at any one time in the best location? And that's what I put together. And well, the first thing that it shows you is, over the long run, interest rates are coming down. That's one clear thing. And I was at an event where I bumped into Steven Pinker, the Harvard professor, who's written extensively on a range of topics. And I told him about the chart, and he immediately offered an opinion. And he said, "Oh, yeah, that's because we're killing each other less." So I thought, okay, so he's not an economist, he's not into finance, and he views it from psychological terms. And so his argument was, we were able to arrange through contracts a safer system, viewed over 5,000 years. So that's what's brought down the cost of capital. And so what this chart shows is, which jurisdiction had the lowest capital at any point. And from there, you can infer certain things. So, for example, there was a period where the Republic of Genoa had the world's lowest interest rate. So that would have coincided with a lot of treasure flowing to Genoa. And in recent years, the world's lowest rate of interest has been in Switzerland. And that also coincides with the fact that there's a lot of capital flowing to Switzerland. So that I found interesting. What is also interesting is all of these jurisdictions eventually blow up. They have the lowest rate and then they disappear from the radar screen, no longer the lowest rate. So I don't know what that means for Switzerland in terms of that chart, but that's perhaps a description, a more detailed description of what I was referring to.
Brilliant. And in terms of negative interest rates, was
Yes.
the recent negative interest rates in Switzerland the first time that had ever happened, as far as we know?
Yes. So if I'm not mistaken, very shortly before Switzerland introduced negative interest rates, it was first introduced in Sweden. However, the Swiss interest rate was the world's lowest ever recorded. Minus 1.25 was the policy rate, was the lower bound of the policy rate. So that was an all-time low, minus 1.25. What I don't include was the minus 40 on US dollar inflows in the 1970s, because that was kind of like not on the Swiss franc. It was in dollars, and they didn't call it interest rates. They called it a commission. But so what we see is in history, there have been cases where a very negative rate can be applied to inflows of capital.
A negative interest rate, or sorry, not negative, a very low interest rate, as you were looking at, can indeed indicate that an economy is in trouble as well and needs lower interest rates in order to pull themselves out of it. How would you differentiate between lower interest rates attracting capital because the economy is doing well, and lower interest rates that reflect an economy under stress, like we've seen recently?
So when you look at this over the very long run, in most cases, low interest rates correlate with lots of capital. a sufficient supply of capital. And higher interest rates tend to correlate with more stress, more inflation, more risk. And so when you have cases, as you just mentioned, the Great Depression of very low interest rates, those are very particular phases, quite short phases. And the reason why they're quite short is because the state eventually figures out how to raise those rates. I mean, it's very easy. It's very easy to generate inflation. We see that in Japan. Inflation up around 3%, right?
What easy you say?
It's taken them long enough. Though. It's taken them 30 years.
You could no. If you or I were, governor of the Bank of Japan, and we wanted to generate inflation, we would be able to do that. It took them long, perhaps because they were very cautious about how they were doing this, and but the ability to generate inflation when you have a fiat currency is relatively easy, and we see this. We can see this in many different economies.
Well, I'd suggest the problem is not so much creating it as keeping a lid on it once it's out of the bottle.
Of course, yeah. But so now Japan has 3% inflation, and so now they've got what they want.
So if we kind of look ahead to the next few years, and let's assume that there is some form of financial collapse and reckoning, how do you think Switzerland would deal with the fact that money is going to flow even harder into the Swiss franc, and possibly with the world in a deflationary implosion, the currency is going to be extremely strong at the wrong time?
So, what we have is this toolkit of things that Switzerland has done in the past, which I looked at in the book. I mentioned a kind of knee-jerk reaction is, panic and let's peg. So they peg to something which might fix the problem for a few months or so, but doesn't really address the bigger issue, because money supply ends up increasing. And so there's a range of measures, and there are two that they haven't applied yet, but there has been some talk about it. So, for example, one of the things that I discovered when they were going through all these different ways to try and keep money out, negative rates and all kinds of things, one of the proposals that I discovered that was discussed but never implemented was to split up the Swiss franc into two. So what that would mean is exporters would have one exchange rate, and financial transactions would have another. So you would kind of protect the exporters, and those who want to buy assets, they have to pay the more expensive rate. That was a kind of a plan in the drawer, but it was so radical it was never introduced. Another thing that one tends to hear in crises when things are really, really bad is capital controls. But this is the opposite. Instead of getting capital flow out, you would try and prevent capital flowing in. That hasn't happened either. But I'm trying to imagine, what are out of this toolkit, what would they do? They would peg, they would introduce negative rates, and only gradually would they panic further in the direction of really extreme measures, is my guess, based on what I've seen, based on what I read.
That's fascinating. I've just bought your book online. I can't wait to read it.
Oh, great.
Yeah, I'm fascinated also by how you obtain the data, and is that available on a is that available basically from a website or somewhere else? I mean, I can't imagine after all the work you've done that you'd immediately want to share it, but it's also something that I think many people would be very interested in obtaining.
Yes. So let me quickly tell you about the data. So this is another thing that I discovered over the years is how much stuff is not on the internet. And you were mentioning students earlier, and this is also something that I noticed is that they're quite unaware of the fact that there are things in archives and in libraries that you can't find on the internet. There's this kind of general reaction that everything's available on the internet. You can just download it. Well, it's not. A lot of stuff is not, and there's fascinating stuff in the archives. Many things have not been digitized. And if you know what you're looking for, you can find great things. And so I was fascinated to find data on exchange rates going back to the 1500s, and great detail. And so people have done work on this, and this is where the data comes from. And what I did was I selected data series. Some of the data series, they suddenly stop because the city is no longer the key trading hub, and then you have to find the next city that is a proxy. So some of the things I had to recreate by trying to find those corresponding values. But it was fascinating, and I think there are many things still waiting to be discovered in plain old books.
That's brilliant. That is brilliant to hear. That's so amazing. I absolutely love that, because it also means that AI can't touch it unless it all gets digitized.
Yeah, and of course I tried with AI, and I tried many things, and the results were just horrible. And that was so encouraging to see that it couldn't do it. It didn't know it. And I was like, yes, I'm onto something.
How long did it take you?
So, I've spent around 10 years building up a database on interest rates and selected currencies. And I would do that in my spare time, free time. And, but the actual writing began the moment the Swiss National Bank told me there's nothing in their archive. So I was like, yes, let me, I have data, I'll find more. So last year, about February, I started writing bits, but the real writing happened this year. I mean, once you have your data, it's pretty easy, right? It's easy. It's easy to write something when you have the data. You're just describing numbers. And so the writing was relatively quick. Several months this year.
I love on the front of the book that you've actually got, I mean, being a chartist, I love charts, of course. So, but I love on the front of the book that you've actually got the chart there, which is just great. You can see what direction it's going in as well.
Yes. So the first wobbly stuff is Napoleonic Wars. The second big plunge down was the US Civil War. Then the next big move is the First World War. And then you have the Great Depression. And interesting, you can hardly see the Second World War having any impact. And then the real collapse of the dollar is in peacetime because of inflation.
Incredible. So, Tim, I was just going to say, any final questions before we were to wrap it up?
Nothing to add.
Okay. And Costa, is there anything that we haven't asked you that you wanted to mention? And just my final questions, perhaps while you think about that, is there a follow-up book to this? Is there anything else that you've got in the pipeline that you're researching?
There are things that I'm thinking about, and one kind of relates to, different templates for different countries. What is it? What is it makes countries special? And what is it makes countries follow a particular policy, over decades, centuries even. That's an area that I'm thinking about, but a topic has to grab you because it's so painful spending time writing.
Absolutely.
You could do a book,
lonely work.
the US dollar 1776 to 2025.
That's quite original.
Oh dear. I mean, that what you mentioned as a subject, goodness me, that would, if it took you 10 years to get the data, it would sound like that would be at least that, if not double, to be able to analyze major countries. And it leads me to another question about, have you been approached by any major either institutions or even political institutions asking you to speak to them or consult, given what you've discovered?
Yeah, so I've received lots and lots of invitations. I mean, yours being one of the very first for a podcast. And so the invitations are from several financial institutions, funds, banks. The banks are rather careful. They want a fireside chat where they can have their chief economist stop me if I say something about, in contrast to their currency forecast,
Oh
perhaps.
my God, that's so typical.
But still, so there are lots of invitations, and I've also just this week been invited to London. It hasn't been formalized yet, but I'll certainly let you know if that is agreed. So there's a lot of interest.
That's brilliant.
That's nice. Yeah,
that's brilliant. If you do come to London, let me know, because I'd love to meet you, and I'd love to have my copy signed as well. So
yeah, it'd be great. Great to meet you.
And so were there any final questions that you wanted to kind of mention that we haven't asked you?
I think we've probably discussed kind of most of the things. I just I mean, there's so many different angles to the book, and different people have focused on different ones, and I think you asked all the key questions. This could be one thing that you haven't asked me and that I haven't mentioned, which I think is an important part of why the Swiss system works financially, is there is a balanced budget amendment. It's in the constitution. The state cannot run deficits over the cycle. Always has to end up at zero. So if you know that there isn't going to be government debt.
I didn't know that. Did you know that, Tim?
No, I was not aware of that.
Wow.
Yeah. So you don't, you don't have a finance minister who can mess things up. You don't have a prime minister who can accidentally do that. The system, it runs on its own. And that, I think, is an important thing. Now, the key safety valve is over the cycle, which is, COVID could happen. We'd run a deficit, so we'd let that happen. The moment COVID is over, we would go back to a surplus because we want to pay for the money we gave out during COVID. And so that's how the system works. And I think that's an important component to the stable environment as well.
When you refer to the cycle, what are you referring to there?
So we talk about a normal business cycle, which is you have trend growth, and are you above or below trend growth? And this cycle and these numbers are calculated by the statisticians, civil servants, and they present their numbers to Parliament. And based on that, Parliament has always accepted their proposal and determines the budget on the basis of that. So if the statisticians say, this is time to move to surplus, then that's what the politicians have done so far. By law, they have to do that.
Have you looked at whether there's a consistent cycle of this playing out, or does it?
So the criticism is that the civil servants have always ended up being too tight. And so there's always been a surplus. And I mean, a very, 0.1% of GDP, tiny. But, some on the left are saying, oh, but, these numbers are just too strict. But the net result has been, over a period of 20 years, I think, an average surplus of 0.6. So you don't have a buildup of debt. Debt is being reduced. So that's very powerful if you know your state is solvent. And anything could happen where the state might have to borrow a lot suddenly. So that's a good buffer. I think it would be perhaps interesting for the UK to consider a system whereby power on the budget is removed from the politicians. It would, first of all, there'd be fewer articles in the newspapers. We wouldn't have to worry about the deficit because we know it's always going to be balanced over the cycle.
Fewer wars.
Sorry?
Fewer wars.
Yeah. Many things could flow from that.
Brilliant. Is there a website dedicated to this, to your book and your work? How do people contact you?
I do have a website that features the book. It's called swissfranc.com with a hyphen between Swiss and franc, I believe. I was surprised that the website was available. And that just has info on the book and me, and allows you to look into the book and you can see which pages are, what kind of graphs there are.
Oh, fantastic. Swiss-franc.com. And obviously it's Frank with a C. That's fantastic. And are you on any other social media, or is this the best way to go?
I'm only on LinkedIn. So what I do is I publish my charts on LinkedIn.
So, Costa, what have you got for us in terms of media picks?
So a book that I enjoyed reading, and it comes back to the issue of what you can find in the archives, was written by Sergei Radchenko, who's a professor at Johns Hopkins. And for a period of about 10 years, he was given access to archives in Moscow and archives in Beijing, covering the Cold War period. And so he was able to see how the leadership in both countries approached things, because these things were classified or closed and certainly not public. And what I find interesting about his book is he adds this very human dimension to what was happening. So my assumption of what drives the Soviet Union, or what drove the Soviet Union or People's Republic, was kind of like institutional and ideological. Their views of Marxism, Leninism, or how they applied that. And what the book shows, in fact, is what these leaders were actually thinking and saying and doing. The notes that they wrote, they've kept all these things in the archive. And they give you a fascinating insight to kind of like a more human approach to understanding their motivations. And I find that fascinating because it's not something that you would typically be taught at a school. And um, that's why I enjoyed this. I particularly appreciated also kind of insights about, Brezhnev's view on the world. And there was a real kind of search for legitimacy and recognition. And you think, well, they're in the Kremlin, in charge of the Soviet Union, and they still need this legitimation by Nixon and others. And the book is full of these kinds of anecdotes. And I
What's
find
the
that
title of the
fascinating.
book again?
To Run the World.
Thank you.
And to run the world is actually a phrase that Brezhnev used in discussing with Kissinger and Nixon, where he was explaining, like, yeah, publicly, we'd have to oppose you, but confidentially between the two of us, we can figure things out and we can actually run the world, and we can have our spheres of influence, and it's just fascinating how that characterization kind of typified how this leadership saw the world and saw human relations.
Fascinating. So Tim, what have you got for us?
So I've just finished reading. I haven't had a chance to read Costa's book, but I look forward to doing so. I've just finished reading Andrew Ross Sorkin's 1929, The Inside Story of the Greatest Crash in Wall Street History.
Ah,
And thematically, it's very similar to what Costas talked about because it has a lot of archival material that I suspect hasn't featured before. So this is from the author of Too Big to Fail, which is the best account of the global financial crisis of 2008. And effectively, it shows that there's nothing new under the sun, that history is continually repeating and humanity learns nothing. It's a gripping read and has a few behind the scenes stories about some of the figures involved, including Messrs. Glass and Stiegel, who financial historians will know are the people responsible for the separation of investment from commercial banking that took place after the crash. It's 1929, and it's a great read.
fantastic. Just makes me think, Costa, of just one last question, if I may, in terms of your book. What was the most surprising thing that you found whilst researching it?
Okay, what surprised me was the fact that the country was actually very wealthy from early on, because the standard view is that somehow Switzerland became wealthy after the Second World War. But the data, and this is described in the book, shows that the country was actually very wealthy very early on. So Adam Smith pointed out that the canton of Bern basically had a sovereign wealth fund and was investing in Britain and was lending money out to the Netherlands and Denmark, because there was just too much money in Switzerland to invest in Switzerland at that time. And so this was a surprise, because even in Switzerland, you would tend to get this view that, we were poor, we had to emigrate, we had famines. Um, and that must have been true, but there was also a lot of wealth. And you can see this from castles and churches and libraries. I mean, the Abbey Library in St. Gallen was founded in the year 900 and had manuscripts going back 1,000 years. I mean, there was clearly wealth and prosperity in this place. And the book kind of reinforces that with data. So I found that kind of interesting.
And that's despite having no natural resources. So it's quite an encouraging message that human ingenuity can achieve an awful lot in the absence of more material things being present.
That's a really good point, Tim.
Yeah.
Absolutely brilliant. Costa, very, very grateful for you to come on this show, and it's been absolutely fantastic. So thank you to Tim for bringing you on and for the contact of Tim's to introduce us. Very timely, because your book's just been released, and fantastic that we're one of the first podcasts. I'm really, honoured about that. And I just wish you all the very best with the book and with your future endeavours. And hopefully we'll get to meet you in London sometime. So please do stay in contact. And we look forward to meeting one day.
That's great. Thank you so much. And I appreciate this a lot.
Thanks, Costa.
Thank you. All the best.
Bye-bye.
Bye. Thanks, everybody. This podcast is for entertainment purposes only. Please do your own research or contact a professional advisor.